Well, joining us now is Krishna Guha from Evercore ISI. Krishna, it's great to have you on. I'm going to start right there because you actually wrote pretty extensively about this week. The fact that we've seen yields up, the dollar down, how unusual is it to see that divergence, and what does it signal?
So it's really important to understand this is a highly, highly abnormal state of affairs for the U.S. When U.S. yields go up, that means there's a higher return on risk-free government bonds. The dollar almost always goes up with that. But that's not what has happened. Over the course of this week, right up until around 11 or 12 o'clock trading today when things started to stabilize a bit, over the course of this week, we saw yields up, dollar down. In fact, over the 4.5 days through to around lunchtime today, we had the biggest move of yields higher, dollar lower that we've seen in the last 30 years, with the sole exception of the week right after Lehman Brothers. So this is not business as usual. When you see yields up, dollar down, there's only really one takeaway, which is that you're seeing capital outflows out of the U.S. into other markets as global investors are rebalancing their portfolios away from the U.S.
Is this a temporary phenomenon, or is this the beginning of a new structural one, given what we're seeing from a trade policy perspective?
So I think the honest answer is we can't be sure about that at this point. But I think this is, my best guess, is that this is neither a 1 week wonder on the one hand, nor the cataclysmic loss of confidence and trust in the dollar and the treasuries, but rather something in between. A fundamentally driven and likely somewhat structural shift in preferences away from the U.S., reflecting two things. The first, in the here and now, is the evaporating U.S. growth exceptionalism. The part that is likely a little bit more structural is the reduced relative attractiveness of risk-free dollar assets as reserve assets in a world where U.S. decision-making has become erratic, where the U.S. is undermining the international economic and security order that the U.S. itself created, where there are concerns about fiscal deficits going forward, particularly if we were to have a recession, perhaps then see the Trump administration and its allies in Congress try to double down on tax cuts to get us out of that huge deficits in that scenario. And all of this made much worse by this wildly irresponsible talk of Mar-a-Lago Accords or user fees on foreign investors in the U.S. bond market, which in the eyes of the rest of the world just sounds like cramming down your creditors.
I think the Trump administration would argue that the dollar's been overvalued for a long time. And we touched on this earlier in the show with Charlie Babrinskoy, and I know David Zervos and Steve Leisman touched on it on CNBC earlier in the day today, too. If you look at how the Fed facilities are structured, they're built for strong dollar outcomes, not for weak dollar outcomes. So how does that speak to, I guess, the way the dollar has historically been perceived and what that now means, not just for fiscal policy, but also for monetary policy?
So to be clear, I would be quite relaxed if the dollar was depreciating based on evolving economic conditions and policy decisions that were leading to bond yields coming down. It's the combination of yields going up and the dollar going down that is highly abnormal, as Neil Kashkari pointed out, and troubling. Now, with respect to how this affects the Fed, the Fed faces an increase in yields that is quite pronounced this week and will tighten financial conditions, potentially pushing an already weak economy weaker, increasing again the risk that instead of getting the weak growth, very weak growth, it's like baseline, we end up tipping into recession. We're not seeing anything that looks like panic liquidation of either treasuries or the currency at this point in time. So there's no need to go to those more extreme conditions. But the Fed needs to, on the one hand, be ready to backstop market liquidity in the treasury market if that were to become necessary, which is not the case today. And at the same time, continue to try to balance this incredibly difficult juggling act between growth risk on the one hand, the likelihood that unemployment's going to rise a fair bit this year, and it was skating at least very close to and maybe over the edge of recession, against this big wave of inflation that's coming as a direct result of the tariffs.